Hello, everyone. Welcome to video 5 of chapter 10. So far, we've talked about putting income into our retirement savings plan, deducting it from our income, hoping to save taxes now, and potentially split income if we have a spousal RSP. Withdrawing from your RSP normally adds to your income, but the CRA recognizes that there's times when we have a big purchase to be made that invests in our future. Two notable things about this would be buying our first home and going to school and getting skill set to improve our job prospects. So starting with buying a home, we have something called the home buyer's plan. It's a chance for an individual to pull from their RSP almost as if taking a loan from the RSP. So it won't immediately be added to income as long as you are consistently repaying those amounts back to the RSP account. Let's go through the rules and the details and hopefully drive home how the home buyer's plan works and how do we make those repayments. So the home buyer's plan is a loan you can take from your RSP to assist in buying your first home. To qualify to have the withdrawal at first, on January 1st of the year, you can't have an existing home buyer's plan. The home buyer's plan isn't meant to be able to consistently take loans and accumulate multiple houses. It's mostly a one-time thing to help you purchase your home. So if you already have a home buyer's plan withdrawal on the books, you can't make another one. The limit of $35,000 per individual, so you can only withdraw up to $35,000 for a home buyer's plan. If you and your spouse both have RSP accounts, then you can withdraw up to $70,000 because that's $35,000 per person. You have to purchase a qualifying home before October 1st of the year following the withdrawal. And the second point is must occupy within 1 year of acquisition. So when we take out our money from the RSP, we can put that money towards a down payment or the purchase of a house. But sometimes there's a timeline in closing. Perhaps we buy a house, but due to the agreement, it's not going to close for up to 3 months, say. The other thing is, what if we're buying a new build? So we're putting money down now, but that house isn't going to be built for 8 or 9 months or whatever the case. So as long as we can move into the house, we occupy the house within 1 year of our withdrawal from the RSP, we can establish that this withdrawal was for the purchase of this home. So the purchase of the home and moving into it substantiates that this was a home buyer's plan withdrawal from the RSP. You also cannot have owned a home in the previous 4 years. The home buyer's plan is to help people get into the buyer's market or the home owner's market. Now, exceptions for this would be if an individual who qualifies for the disability tax credit and home is more accessible or better suited. So, in this situation, the homebuyer's plan is not to assist landlords in accumulating additional houses. But if I'm moving from one house to the next, ideally I will have equity in my first home, and that's assisting my purchase of the next home. But if something happens and I get an injury or a disability, that means I can no longer move about my house. Let's say I had a 2-story or 3-story house. But something happens and now I can no longer climb the stairs. Well, now that 2-story house isn't really reasonable or functional for me. So my need to purchase a different home is sort of non-optional. So if I'm in this situation where I need to find a new house that's better suited for my maneuverability, then that can allow me to withdraw from the home buyer's plan because it is up to me to choose to move, but it's my situation that dictated that more so than my desire to have a different house. The other exceptions for a marriage breakdown, if I'm separating or divorcing from my spouse, I'm likely not getting all of the equity out of the house to assist in purchasing the new one. So I then can take a home buyer's plan to help me financially move into my own space. Now, there's limits on deductions for new RSP contributions. The limits are we put money into an RSP for retirement, and for that reason, we're allowed to deduct it from our income. But if I'm planning on buying the house the same year, the government doesn't want me just putting income into the retirement savings plan, getting the deduction, and then immediately pulling it right out for some other purpose. So they want to ensure that the money being put into my RSP is intentionally for retirement. But they do allow that there is this other situation where, this is a big purchase and I need help with it. So in order to withdraw that $35,000 in RSP, they want to make sure that that amount of money has sat in the RSP for a certain amount of time to demonstrate that, yes, this is for retirement. Um, so in this example, there is an ordering rule of withdrawals. We've accumulated 35,000 in the RSP, so there's that amount within the RSP now. We contributed an additional $10,000 in February. A month later, we withdrew 35,000 under the home buyers plan in March 2023. So we can still have the $10,000 deduction because we can state that the $35 we're withdrawing is the money that was already there. If we didn't have enough money in the RSP, then that 10,000 we put in and immediately pulled out, we wouldn't get the deduction and it would still mess with our contribution space. So we don't want to be doing that. But if we have a certain amount of money available in our RSP, we can say, okay, we're withdrawing the existing RSP, and this is a new contribution. So you want to make sure you have the funds in your RSP that you're pulling from, because if it's too new, the government will say, goes, okay, well, you're just trying, really, that money's for the house. You're just trying to use the RSP in a way that's not intended to benefit from the deduction. But anyway, so as just ensure that you have the $35,000 in an RSP and that it has sat for a few months to just demonstrate this is my retirement savings. Please, can I use it for something else? Now, the home buyer's plan is a loan, so it has to be repaid. The annual repayments default to be paid over a 15-year period, and they begin in the second calendar year following the withdrawal year. So when you pull the money out, you have 1 year to move into your house, and then the repayments start the year after that. So during that first year, you can try and repay all of the home buyer's plan. You can repay as much as you want in a year. The repayment plan that's defaulted is just the minimum amount. So they take whatever your withdrawal is, they break it down into 15 years, and you repay a bit of it every year. So any RSP contributions you make during the year or the first 60 days is designated as HPB repayment first. So it's stated that you are trying to repay this plan before you can take any further deductions. There's no upper limit for repayment, but the repayment has to at least meet the formula, the minimum of the formula. If your contributions don't meet that minimum, then whatever that difference is get added to your income. So let's say I loaned $15,000, that repayment's $1,000 a year. So if there's a year I make no payment contributions to the RSP, that 1 year's payment, $1,000, will get added to my income. And then the next year, I can make that payment, that $1,000, to not include it in my income. So any amounts I don't pay in a given year is expected, like, okay, well then because that's $1,000 that should have been repaid, since you didn't, that $1,000 is income. If I repay $3,000, at least $1,000 of it is the home buyer's plan, and for the other 2,000, I can take a deduction from my income, saying these are new contributions, or I can say, no, I'm paying back the home buyer's plan faster than I need to get that balance down. So as an example schedule, let's say we withdrew $15,000 for the home buyer's plan in 2021, so that our payments are going to start 2023, 2 calendar years later. So repayment of $2,400 in 23, repayment of $600 in 2024. So in 2023, 15,000 divided by 15 is 1,000 a year. Our minimum repayment acquired is $1,000. We have to make that payment. There's no deficit because we met the $1,000 because we paid over that amount, $2,400. So we can we can say all of that was for the home buyer's plan repayment. So we took no further income deductions. So the next year, we take that 15,000 minus 2,400. That's our new balance. And that will be broken up over 14 years. So now our annual payment went from 1,000 to $900. In 2024, we only paid 600. So only $600 was repaid. We should have paid 900. That $300 deficiency will be added to our net income in 2024. The payment we didn't make is considered extra income. Okay. So the home buyer's plan in 2022, Miss DeBoo withdraws $18,000 from the RSP under the provisions of the HBP. Due to the unexpected income received in 2023, she repaid $5,000 in that year. What is the amount of her minimum required payment for 2024? So for this question, I've just set out how long it takes her to repay the balance. She originally withdrew $18,000 in 2022, and then the next year she repaid $5,000. So we have a balance closing of at 2023 of $13,000. The second year after withdrawal, 1, 2, that's when repayments start. So since we withdrew in 2022, our repayments have to start by 2024. We already have made $5,000, so we take the new balance and we divide that over the 15 years. So our annual payment needs to be $867. So we need to make that payment. If we don't make the payment, 867 is added to income and the payment's considered to be made. So the next balance, 12,133, 13,000 minus our minimum payment, that 12,133 gets divided by 14 years, sets the minimum payment. Let's say this year we paid $500. Our income inclusion is 367, our minimum minus what we contributed. And the full 867 is considered to be repaid. We gave 500. The difference was added to our income. So our next year takes the balance. We have 13 years left. That leaves 867. So it has a new breakout every year because we paid down an excess amount. Our balance that's left gets divided over the remaining amount of time. So let's say after 5 years, we gave $4,000. Well, now we have no income inclusion. Our balance is now 5533. So at 5533 divided by 10 years, now our payments go down to 553. So this breakout of number of years remaining gets recalculated every time at the end of every year. So hopefully that's clear enough. The question didn't ask to go all the way down the line. It was only just asking about these 3 years, but I just wanted to show we have a withdrawal, our repayment changed our balance, which affected our annual repayment. If we don't make this payment, it gets added to income. Any additional payments we make will further reduce our home buyer's plan balance. So in the next year, when it's broken for the remaining time, we can reduce the required payment going forward. Okay. Similar to the home buyer's plan, we have the tax-free first home savings account. Housing in Canada has got much more difficult to pursue in the last 5 years. So in 2022, the federal budget allows for the sufficient funds to purchase the first home. So this tax-free first home savings account was a special registered account put in specifically to help people save for their first home. It functions a lot like an RSP. It combines the features of both a TFSA and RSP. Annual contributions entitle contributor to a deduction similar to an RSP, except it doesn't get that 60-day timeline. You have to make contributions in the year. RSPs get an extra 60 days. You have to make your contributions by the end of February. That allows people to recognize their income and then make their contribution. But the tax-free savings account doesn't, the first home savings account doesn't have that grace period. Contributions in 2023 apply to 2023. So if I contribute to the savings account, I can deduct it from income. The first home savings account contributions made in year do not need to be deducted in year, similar to an RSP. They can be carried forward. And qualifying withdrawals are not required to be included in income. So it's pretty much tax-free. So if I put money into this account, earn some investment income on it, and then withdraw it to purchase a home, I don't need to declare that income for taxes. As long as it's made to purchase a first home on conditions similar to the home buyer's plan. If the individual decides to not purchase a home or uses less than all of the funds, they have the option to transfer the funds into their RSP or RIF on a tax-free rollover. Since the account was treated like an RSP, it used up the same functions. We can move it into our RSP if it turned out we didn't need all the income, all the funds. To use the first home savings account, you need to be 18 and over and a resident in Canada as long as you do not live in a home they owned in the year the savings account was first opened or in the 4 preceding years. Again, these provisions are meant to help new homeowners enter the market. So if you already own a home, if you're already benefiting from equity and increased home prices, if your own home has gained value, then you don't quite benefit from this because it's meant to help new homeowners get in. Um, So the savings account's required to terminate within 15-year anniversary of opening the account or when the individual turns 71. So it's meant for new homeowners. So if I'm putting money into this tax-free savings account and after 15 years I don't use the funds, well, now it's no longer tax-free. I wasn't using it to save for a house. I was using it to try and get those tax-free contributions. Maximum of $8,000 annual contributions, accumulating to a maximum of $40,000 lifetime limit. And if you over contribute, it's $1,000 per month. So this is a relatively new savings account. It's a lower priority than those RSP home buyers plan, lifelong learning plan that we'll talk about in a minute. Withdrawals can be made in a single or series of withdrawals, but the home must not have been owned before withdrawals are made. So I can't just take the money and apply it against an existing mortgage. It must be used to buy a new home. We already mentioned the ability to transfer to an RSP. If contributions less than $8,000 are made, the unused limit can be carried forward. So you don't have to make the annual contribution. The space is accumulating for you, and when you're ready to use it, it's available. You can use both the home buyer's plan and the home savings account towards the purchase of your house. I'm not going to worry about the fiscal update here. General rules. This is for the lifelong learning plan. This is when I've taken money from my RSP not to buy a house, but to go to school. And I will say it functions very similarly to the home buyer's plan. The major difference is that it's repaid over 10 years instead of 15. The limit on withdrawal is $10,000 in any one calendar year. You can pull up to $20,000 over 4 calendar years. So it's the idea being that many university degrees are 3 or 4 years, many are 4. So assuming that I'm pulling money to go to school for a degree, the expectation is I will complete that degree in 4 years. So if I withdraw the first $10,000, pay some tuition, a couple years later, pull another $10,000 to cover my remaining classes. So $20,000 maximum over a 4-year period, intending for someone to finish their schooling in that time. To qualify, you need to be full-time enrolled in a qualifying educational program, usually at a recognized institution, pretty much saying, this is a recognized school I'm going to, and I'm going full-time. Entitled to enroll prior to March of year following withdrawal. So I don't want to take the money now, but I'm not going to start school in 3 years. If I'm pulling the money now, I need to be getting into the program within this academic year. So you have to enroll prior to March, the following year of withdrawal. So if I withdraw it in September, that's the start of a semester. I need to get into my courses before March. The designated person for withdrawal can be the individual or spouse, but individual cannot have a lifelong learning plan balance owing for more than one person at a time. So just like the home buyers plan, it's not meant for you to continuously withdraw. So you can withdraw from the lifelong learning plan again if you want to go back to grad school, but you have to repay your original loan first before you can take a new one. The deductible contribution limits are the same as the home buyers plan. There's no limit on times you can participate in the LLP, but must repay your previous plans. So we've already mentioned that it repays over 10 years instead of the 15 years at the home buyers plan, but you do have more time to make that first payment. As I've mentioned, that it's expected that many programs are 4 years. So once you make your withdrawal, you go to school for 4 years. You don't have to start repaying the LLP until the second year after you're done schooling. So begins the second year in which individual not enrolled in qualifying educational program. This is expected to be no later than the 5th year after year of your first withdrawal. So when you make your first withdrawal, you have until year 6 to start your repayments. Your year of withdrawal, 4 years of school, an extra year. Those are when your repayments start. So minimum repayments are straight line over 10 years. Any deficient repayments included in income, just like the home buyer's plan. So giving that example, so Jean Riopel makes an LLP withdrawal of $5,000 in 2022. This is subsequent to his acceptance in a community college art program that runs from September to November 2022. He completes the course on February 28th of each year up to and including 2034. He remakes the payments of $500 per year to his RSP. These amounts are designated as LLP repayments for his income tax returns. For 2024 up to 2033 indicate the tax consequences for Jean Paul. So we are told he withdrew $5,000. He finished the program. It was only about 12 weeks or so. So he finished the course in 2022. So his repayments start in the second year following the end of his enrollment. So 1, 2. So the repayments start in 2024. So we take the ending balance, divide it by the number of years remaining, and that gets our our minimum repayment. So we're told that the annual repayments being made is $500. Since this matches the minimum repayments, he is successfully repaying the RSP amounts. So there's nothing to include in income. Does it from 2024 to 2033. So by 2034, this balance is fully repaid. Okay, so that's the end of the loans from an RSP. So home buyers plan, the lifelong learning plan, those are the priority subjects. It's good to know of the tax-free home savings account because the calculations that we do are associated with the 2 loans you can take from the RSP, I would focus on making sure you understand how to calculate that. When we come back in the next video, we're going to discuss what happens when you need to stop or close your RSP. Thank you for your time. See you in the next video.